rally or ruse in your book?
We will likely get a mix of the two. Tactically, risk-reward has clearly improved post-crash, but strategically, a top is in. But that will likely play out for the remainder of the year into 2025. That's our base case at RW Advisory. Our thesis has been a behavioral inflection point since the start of the year, which is now reversed. But essentially what that means is a bull trap squeeze where there's a lot of leveraged bullish views on the back of a consensus soft landing view, which ultimately is now make or break. And so the key level to be watching on S&P 500 is at the 5,200 mark. That will decide whether this bounce back holds or whether we break down lower. Certainly we could get an in excess of 10% correction into the 15% mark or more.
So those who are not familiar with the term bull trap, just again, this is a potential exit point actually for investors, not an entry point.
Absolutely, it's for selling. And it's basically when a lot of the bullish consensus is proven wrong. So for that reason, it can be quite dramatic, and that's certainly what we were looking for over the last tactical period, because the markets were under pressure, a triple whammy headwind of extreme momentum, rotation fragility, and cycle asymmetric risk.
Ron, let's just get into some of the graphs as well that you have put forward. And if you talk about that bull trap reversal pattern, I'm just wondering then, is that make or break zone as difficult one, or is that where you think that markets will really just continue to head completely lower, especially if passes below, what is it, just below 5,200? Is that a key level then that you're fearing right now in this market play?
It's a key level that the market must test and prove itself, as it were. Each market crash is different to another, but they tend to follow a three-stage pattern: fall, rally, then rest of fall, or a variation of that. So we do need to watch the charts to see how that plays out. Scenario planning is a great idea. Right now we're base case looking for lower levels ahead, but certainly there are other likelihoods. Keep in mind what happened in October, where we did have a drawdown to the effect of about 10%. That would equate to the long-term 200-day moving average here and now.
We did have April, though, and if you look at the chart back in April in the S&P 500, looks like that could have been the same pattern, right? We had a sell-off, had a bounce back, a bit more selling, but actually then ultimately we went up. We didn't go down, and we went up a fair amount. So why is this not April?
Yes, well, time has passed and the markets became more overextended in terms of the original three factors mentioning the excessive momentum, but also the fact that we had ongoing signs of rotation fragility. And back in Q1, tech seemed to look even more frothy. Then we had that fast rotation into value, which wasn't viable or sustainable. And so in a way, it was the last trigger to take place. And we've since had a perfect storm of other factors that have triggered the market down.
I'm actually just looking at the graph we had just a moment ago as well, and really just talking about those tactical risks, particularly in the Q3 to September or so, then as part of a strategic top then by 2025. I mean, does that ultimately mean that we're going to see this market still actually lose out quite significantly as we head into next year?
Eventually, yes, and certainly having a barbell strategy where we can remain long of those selective profitable trades, but trim where necessary, hedge downside risk, especially into year-end and the new year, as well as remain diversified somehow, some way. Gold is a good play still, especially on a relative basis. The cycles tactically, based on a range of different drivers on the screens, is a proprietary model by the Foundation for the Study of Cycles, where I'm part of the team. That shows the marker for the fall that's already happened, but also the peak that preceded it, and a bottom in September where most of the traditional drawdown is. That's confirmed by the typical negative seasonality of Q3 into September more so. We have the Fed policy meeting then, so that potentially some event risk. And then not so later afterwards, we have US elections in November. That amplifies the negative skew, particularly this year where uncertainty is more heightened, plus we have geopolitical risk, which just to add a little bit more concerns to that. Long term, what this all suggests on the chart on the right, that this is likely part of a strategic top in play for the new year.